Hello there, everybody. G'day. Welcome along to this Thursday afternoon market recap. I will preface this by saying that as I sit down and bring you this recording, there is still approximately 2 hours left in today's session. So this is a little bit of an early update. I have been a little bit silent, you could say, on the airwaves here, at least publicly on the YouTube channel. Again, I'm just allowing this market essentially enough time and space to air and continue to allow a lot of these kindred spirits to flow into the markets. Obviously, there has been quite the hysteria going on with the markets. A lot of people, again, assuming that we're in that state of the sort of the return to normal prospect of the economy at large, and also for the financial markets. The Fed yesterday coming out and essentially saying that they're leaving interest rates at zero, essentially for the next 2 years, or at least extended out to 2022. They aren't even thinking of raising rates at this particular point. Again, the Fed still largely acting as a backstop for the markets, especially the treasury market in terms of liquidity. And again, a lot of people assuming that the markets themselves were going to continue on their merry ways, right? Continuing in the direction off from the March 23rd lows. Here we are at this particular juncture, again, the fourth trading session of this week. Not only have we seen an adverse, or at least a very negative reaction to the Fed commentary yesterday, but also on top of that, we have given back a lot of the gains that were originally made earlier on in the week, but also we're coming back and sort of repricing a lot of the market activity that was happening leading up into what appears to be that of this secondary subsequent major low on the Russell 2000. Again, no particular reason why I am starting on the Russell 2000. I will switch on over into the S&P, the Dow Jones, and the Nasdaq in a couple of moments' time. But it appears as though risk off is very much so the case at this particular time. The markets have been quite extended, quite overbought for an extended period. And again, on the daily time frame, you can see that we're only just starting to adjust out of oversold conditions that we have been in really since the midpoint of April. Yes, we oscillated out of them, albeit temporarily in the period of May. But again, the speculative bid, that reach for more and more dangerous yield returns or yield types has helped this market rise back on up, or at least the Russell 2000 up to roughly that 1500 area on my screen at the moment. But you can see again a very quick, a very sudden, a very severe reaction and a complete rejection off from this general resistance area that we've had highlighted on our screen, which is essentially again the back test of this critical trend line, which has had this whole bull market in effect since the lows going back to 2009. Okay, so here's the 2009. We've got these multiple fan decelerating lines on my screen, and if you project this out to the current juncture over here, you can see that obviously we broke down below this in the month of February, March. We've rallied back on up to retest this from the bottom, and old support, it operates as new resistance. Now again, we still have obviously a little bit left in Thursday's session. We also have Friday's session to see the real true weekly closing print, but at this particular point, this is a little bit of a pseudo tweezer top candlestick. It's also mixed with an outside day engulfing candle on the weekly chart. So if there is, or at least what's most important about candlesticks, very similar to real estate, is location, location, location. And this type of reversal signal that we're seeing up and around this resistance area is very, very important, right? It's telling you something. It's telling you that the price is up here. Again, as we come back to retest a lot of the support areas that held, during 2019 very clearly, or as at Thursday, very clearly they are being rejected at this particular point. There has been a lot of interesting price action, you could say, if you're thinking about just the speculative nature of this market. You've obviously probably heard, or at least read about the rise in new Robinhood accounts, active trading accounts, and also the positions held in those accounts. Also, if you have a look at some trend searches through Google, if you look at people who are just for the first time searching how to trade stocks, and also secondary to that, how to trade options or what is a call option. If you look at those search results through Google Trends, it is just off the absolute charts. There's a lot of new, or at least very recent, market participants re-entering this market since the March 23rd lows. And a lot of the price action, I assume at this particular point, as institutional investors have largely been on the sidelines watching this market rally back and up into these resistance areas, More recently, a lot of this price action is probably done or has been made and also exacerbated through the rise of these new connections back into the market, or feeding back into the market. You can have a look at a lot of these recent stocks that have declared bankruptcy. Hertz is a great example of that, seeing that speculative price action after actually declaring bankruptcy a number of weeks ago, trading down as low as I think 60 cents, to see it blow out to say $6, and to see it now retesting or at least coming back down right shy of this $2 area at this particular point. This stock for the most part, right, it's going to zero, right, definitively. But just to see a lot of these pump and dumps sort of occurring in a lot, I mean, Hertz is just one example of this, but to see this happening in the market, and also in other prominent shares, the rotation into, of course, tech at this particular point, again, it has me very concerned about the health, right, the longevity of this market, to see some just absolutely bizarre price action continue and really be exacerbated since what I believe to be a false breakout out of this resistance area, taking us back to last month, right, whereby in May, it was appearing as though these markets were holding above their 10 and 20-day monthly, right, exponentially weighted moving averages, and also, of course, largely contained below, right, the 100 and the 200-day simple moving averages from the very beginning. Since these compression lows over here down at March 23rd, we've been calling for these markets to come all the way back and up and retest essentially the rising 100, or at least the sideways moving, not the rising, but the sideways moving, 100 and 200-day simple moving averages. Now, again, yes, we have overshot these, but as it stands, again, it looks as though maybe we're retesting these from the top. I don't think that's the case. I think we are going to break down below them. But if this is the case, it is really going to show up in those monthly charts that I have been speaking to you about over the past number of months as we've been rallying back and up into these resistance areas. Think about it this way as well. Generally what happens is, if you're talking about a new cyclical bull market in the beginning of a new macroeconomic expansion, right? Just to put this in context too, is that we've been in an expansion from 2009. Here we are in 2020. This bull market, I think, has lasted 128 months. It's 10 months, a little bit old, or a little bit older than that, essentially 10 years, right? And to think that this cyclical bear has run its course after the space of a 1 month sell-off, I think it's just being a little bit foolish at this particular point, a little bit delirious, and largely just, again, gasping and hoping through optimism that this market is somehow going to continue above its all-time highs. I know the Nasdaq has achieved this at this particular point, but if you're looking at the real breadth of the US economy, whether it's the Russell 2000 or the Wilshire market index as well, from more broader look, even outside of the Russell 2000, I think it's going to be very difficult, and I've said this from the very start, that even the S&P would be able to break to a new all-time high. So we're going to have to monitor this. But getting back into that original discussion that I was going down, if you're thinking about the new beginning of a cyclical bull market, so to speak, generally what you see is strength in financials. Just before I continue with this chain of thought, what we've seen also, which has only happened really on 2 other occasions in the last 20 years, is an overperformance of the Nasdaq, right, or an outperformance of the Nasdaq relative to the S&P 500. More recently, to the extent that we've seen in the bear market rally of 2001 and also 2008. So again, during this rebound, which again I'm still calling to be that of a bear market bounce, right, or a bear market rally, dead cat bounce, so to speak, the outperformance of the Nasdaq, which again is broken to a new all-time high relative to the strength that we're seeing in the S&P 500. And of course, that extends to the Dow Jones Industrial Average, have only been really seen on 2 other occasions, which have also coincided with bear market bounces as well. But jumping back on board with the actual thought and the discussion about the financials, when you're talking about, again, the beginning of a new macroeconomic bull market expansion, generally what happens is the financials will rally first off from the lows, and there will be a lot of participation in this. And what's interesting about this move, this is the XLF, this is the financial sector ETF at this particular point. If I bring this up, what we've just achieved obviously has been the sell-off into the March 23rd lows, or really coinciding with the broader market indices. And yes, the financials, they have participated in what has been, right, a very powerful bounce off the compression lows of March 23rd. But if you pay attention to this again and just see where they've rallied back on up into, it's a very clear rejection off from this 200-day simple moving average. Now, I wanted to preface this as well. This is only taking into consideration at this particular point the closing price action as at Wednesday. So when it comes to the daily individual stocks that I'm going to show you in this video, this is not factoring in, right, the price action that we're seeing today as at Thursday. So as it stands, XLF is considerably below where this dark candlestick is. And again, this is coinciding with the XLF, which has been overbought on the daily time frame, especially through the settings on the RSI here, and the MACD is just beginning to turn down. If you go out to the weekly, right, these are still really net negative below the neutral point. And the financials, if I just bring up a couple of these individual shares, again, it's not factoring in that of Thursday's price action at this particular point. You can see also, if I bring this up, JPM, again, a very clear rejection off from its 200-day simple moving average. If I show you this on, say, for instance, Wells Fargo as well, right, off from the 100-day simple moving average. If I show you, I can show you Bank of America, BA. Oh, if my, let me just cancel this. I'll reopen it. There we go, BAC. You can see all the financial stocks getting very clear ejections off from, right? They're sideways moving, but bearishly aligned with the 100 below the 200-day simple moving averages. So I think this is another canary, so to speak, in the coal mine, and it really is some form of a rebuttal against that of a new cyclical bull. We'll see whether or not we can actually hold up above, right, these 200-day simple moving averages. But what it is showing is that it seems as though this short covering largely induced speculative bid that we've seen enter the market from a lot of people speculating, right, on the advance of certain companies in particular, again, leisure and travel in particular, that have been absolutely belted down. A lot of this money, I think, is beginning to fade, or at least they are starting to sell to close. And what's interesting too is that there has been a complete capitulation of the bears, so to speak, in general, right? Leading into the week, or this week in particular, you could almost say that the bears sort of have essentially thrown in the towel, right? And everyone has just been such in a speculative bullish frenzy, thinking that, oh, everything's contained, everything's getting back to normal once again, and these markets are setting off on a new macro bull market theme. I just simply don't see that to be the case at this particular point. I think right now as it stands, unfortunately, but the reality is new cases are increasing, right, of COVID-19 in 21 states. And you've got talk again of somehow, or at least the Fed's coming out saying not to shut down essentially the economy again, but a lot of individual states are now talking about, is there going to be a second round of shutdowns with the spike in new cases? So something to think about as well. Again, keep an eye on that. It's far from gone at this particular point. We all want it to be gone, but the reality is that it appears as though the second wave is largely upon parts of the world, not only conducive to the United States, but we are seeing upticks elsewhere in the world as well. I think, in fact, it was only a couple of days ago, in fact, where we saw the most new daily cases since the beginning of this COVID outbreak. So again, that's something to think about too. But going back into the actual technical analysis of these markets, if I show you this on the Russell 2000, I've recapped, of course, this bearish outside day engulfing candle. This is on the weekly print. We still need to see, obviously, how we close as at Thursday, and also see what happens during Friday's session. But if I go out into the monthly charts, and this is very telling, I've been beating the drum, so to speak, on this indicator because I think it's really fantastic. When you see the US unemployment rate where it currently is, when you see the leading economic indicators as well positioned the way that they are, and you see the breakdown of some of these macro trend lines on these markets, right? Price action generally, and I say generally, I shouldn't sugarcoat it whatsoever. It's horrendous following, right, the setup of these events. And what you're seeing right now on the Russell 2000, right, at least on the monthly chart, I know we're very early on in the period of June. Here we are. We're not even halfway into the month. But as it stands, it's not only conducive to the Russell 2000, but we're also seeing this similar setup on the S&P, the Dow, and the Nasdaq at this particular point, is that we have gotten above more recently, both the 10 and the 20, even the 50-day. Right, exponentially weighted monthly moving averages. Everyone's getting really excited about this. This candlestick only a couple of days ago was a long white day Morobozu candlestick, which had everyone excited. And again, that's the market, in my opinion, essentially what bear markets are designed to do, to draw people in, right, and encourage them that things are moving back to the way they were. And I've said from the very beginning that they're not, right? Unfortunately, it's a different world that we're operating in post-COVID. The pre-COVID world is stretched as what it was in terms of the financials here, at least the financial markets. It's really taken a sledgehammer to growth at this particular point. And the revisions that we're seeing, the continued revisions in GDP, and the JOLTS reports as well, industrial production or lack thereof, they're pretty terrible. It's the worst data that we've seen in the history, really, of some of these economic statistics coming out of the US and for a lot of the parts of the world. But anyway, getting back on into this, you can see right now, the way that the Russell is positioned is that now we're back below all three of these exponentially weighted moving averages, which isn't a good sign. So if we continue to see follow through below this area, like we have seen during the 2000 peak and also during that of the transitional bull to bear market top of 2007, this is a very ominous signal just here. And I wanted to keep you updated on it. I know sometimes it can feel like the bulls are returning and that everything's going back to the way people envisioned it, or at least thought it was in 19, but very quickly these things can change as well. And that's really why I've just been sort of essentially keeping quiet and just watching these markets from afar. If I show you this also on the Dow Jones Industrial Average, you can see this is the monthly chart of the Dow Jones. You can see another shooting star candlestick, and the way it's positioned at the moment is that we're sitting right on both the 10 and also the 20-day exponentially weighted moving averages on the monthly chart. Now, it's a little bit of a different picture here. We are technically still above this bullish trend line. This is going to take some time to finesse, but as it stands, this is a very early, warning signal that after you get the first break below it, you come back on up to retest it, If we get a definitive move, a closing price and a continuation below these areas, just be warned that generally things do not end well, especially for retail bag holders, so to speak. Unfortunately, the non-institutional money or the retail money, if they're left holding the bag of this bull market, sort of that the hot potato which is being thrown around to market participants in terms of volatile assets traded on the US financial markets. Now, this is where the complexion starts to, change a little bit when I bring up the S&P 500. You can see that we still have that of a shooting star candlestick, so to speak, on the monthly. Again, if I go out to the weekly, you can see this tweezer top outside day engulfing sort of weekly candle at the moment. I'll go back into the Dow Jones because, again, I didn't recap this, but you can see this at the weekly, that we're getting the rejection at that 50-day exponentially weighted moving average. I can show you it here. On the S&P, we're still holding up above it at this particular point. But when I go back into the monthly chart of the S&P 500, you can see that in the context of this individual candlestick here, it's all about location of candlesticks, It really derives its meaning right at these general areas of resistance, you could say. So we have seen this snapback rally whereby I think we've overshot to the extent, or at least the rally off from the lows is somewhere around 73% of that initial downward move, from the Feb highs down to the March lows. But this is an early reversal signal, We'll see whether it has any legs. But if we were to definitively crack below, say, 2,914, and just think about this only really as at Monday when we were up here trading at 3,225. If I was to say that, look, there's a chance the S&P is going to close the week below 3,000, you'd probably call me crazy. And again, that's just highlighting the speculative nature of this market. But going back into the monthly chart of these exponentially weighted moving averages, if we were to see the S&P fall below its 20-day, which is positioned at, say, 2,900 points. I know that's another, 150 points away from where we're currently trading. That would be a very clear reversal signal, and it would really confirm a lot of what I've been speaking about over the past number of months since, this compression rally out of the March 23rd lows. So it's interesting. The markets are continuing, to give us more and more indication of where they want to go. What I think is fascinating at this particular point is that the Nasdaq actually rotated to a fresh new all-time high. I've been speaking about divergences a lot. Look, I haven't gone anywhere near these markets. I've been very, very straight with you on what I'm not doing in the financial markets, and that is taking speculative bullish positions. At this particular point, there is a lot of risk out there. The markets itself assumed at this particular point as if they're pricing for no risk and that the Fed is the backstop. I just think that's very dangerous to think that the Fed can levitate financial markets forever, up in these historical areas of valuations. And also, in terms of the actual sell-off that we saw, and if people are calling this, there's no doubt, by the way, that we're in a recession. In fact, I think it was the NEBR on Monday or Tuesday came out and then, technically said, yes, we are in the beginning of a recession. Just wanted to say that we're very much on the left shoulder, the cusp of the uptick of this downturn, if that makes sense. And we're only just beginning to enter into the credit default cycle as well. So pay attention to that. I know the Fed is obviously helping out in the bond market, also in the corporate bond market more recently, but we're only just moving into the first phase of, unfortunately, this default cycle. So we're very early on in this entire sort of recession, contraction, you could say, and the extent of the damage which is going to be done to these companies, it still is a little bit uncertain, but by all means, it's nowhere near finished. I just wanted to point that out as well. But jumping back into the Nasdaq anyway, the Nasdaq has been the one market to actually produce and create a new all-time high, which was a little bit of a surprise to me. At the moment, it's pulled back down below it. We got above 10,000 marginally. Just a big reminder, it was only back in the year 2000 whereby the Nasdaq hit the psychological round number of 5,000 points. So if I go all the way back and show you this, it looks like a lot because obviously went through the bear market of '08. But if I go all the way back, you can see it's not even highlighted on my screen, but I'm trying to bring it back anyway. The speculative blow off top over here, if I can zoom on in and show you this, I think there are parallels. That's why I'm showing you this, was essentially to the penny of 5,000 over here, right? That marked the top of the Nasdaq. Things seem to be, right, obviously returning to normal during that cyclical bear, but you can see ultimately the bottom fell out of the market. Now, I assume that we're in the process of doing the same thing. Everyone assumes that the lows that were priced in on March 23rd, there's no chance that they can be taken out. It's almost like a consensus view that these lows are not going to be revisited, let alone taken out. And for that matter, based on where we are and just the whole sentiment shift that you're seeing in market participants, whereby, again, this was the most scariest market largely of their lifetimes during this meltdown, to now people just doing everything that they can to put more risk on or to be more aggressive in the market. It generally does mark very close to that of a market top in a transitional period. But going back into the Nasdaq, I just wanted to point out that when you look at this on some of the daily, the daily and weekly timeframes, we do have divergences now established. All right, and they are pretty strong. So again, we'll see whether there is any longevity to this breakout that we have seen more recently earlier on in this week. You can see the MACD, it's still pretty much plateauing up here at the overbought, or at least the overextended in terms of momentum settings. The stochastics is still trying to turn down. We're creating essentially a higher high, as I've already recapped for you. But I mean, that's the prettiest picture of all the markets, right? I'm showing you the strongest individual market at this particular point. When I start to show you this again through the eyes of, I guess, counterpart markets, you can see here on the Dow Jones Industrial Average, a similar chart on the weekly time frame. You're just not seeing that confirmation at this particular point. In fact, the MACD, it's still in negative territory, which is a little bit shocking. If you have a look mixed with that shooting star I've shown you on the monthly time frame to show you the trajectory of the MACD at this particular point, it's not really firming up. It has more recently, or at least the momentum of this move is obviously slowed on the monthly time frame through the direction of the histograms. However, right, this is a counter-trend cyclical bounce. So again, just to keep things in perspective, that's the Dow Jones Industrial Average, the S&P 500. I mean, it's still technically overbought. So if you thought that the market on a daily time frame moved into oversold settings, which it did, when you go out into the monthly charts, we're still technically overbought, which is, I think anyway, pretty frightening in the context of what we're looking at here. So here's the Russell 2001 final time. You can see it very clearly being rejected off from its macro primary trend line, which has been in effect since 2009. Maybe this is a better way of showing you this on the monthly time frame. Here's the low, right? And when you break these on the big macro pictures, right, it generally is obviously a forward-looking indicator of where the economy is going when you're thinking about the individual stocks that encompassed or are encompassed on the Russell 2000. So again, I think there has been a celebratory victory lap, which is very premature in the world of finance at this particular point. And right now at the moment, I can feel, so to speak, the ground shaking a little bit. I'm not all out immediate bearish. We have seen a very quick move over more recently this week. The markets have been on a daily time frame exceptionally overbought, but we are still seeing reversal signals, and I know they haven't played out. However, I do want to emphasize, as I say farewell to you, right, as at Thursday, these monthly charts, where the 10 and the 20 exponentially weighted moving averages are, right? This is the Dow Jones Industrial Average now flashing red. You've got the Russell 2000, right, flashing red, right at its logical area of resistance. You've got the S&P, which is holding up better. However, you've got the monthly reversal signal here, and also, right, you've got the Nasdaq. I didn't mean to actually change around my descriptions. You've got the Nasdaq over here, which has got bearish divergence all over it, and very poor relative strength too, right, and potentially that of a double top. We'll see how it plays out. But there is still a lot of risk, even if it's not really being priced into the market at this particular point, or if it seems as though the bulls have control. They have had control, and they have very, very much so had control from the March 23rd lows. But I think this victory lap, so to speak, is going to be short-lived. Pay attention to that. Also pay attention to the S&P 500 moving back below its 200-day simple moving average. If this was to happen to see a definitive close, generally you don't need much else in the world of technical analysis to assume that we are then, right, moving into, even technically speaking, that of bear market price activity over an extended period of time. So keep an eye on it. I thought you would appreciate this update. I know I haven't been, again, public, or at least putting out public videos over the past couple of weeks, but really I've just been waiting for something like this to happen, right? And I think it's justified at this particular time. So again, if you're looking to buy this market, I'd encourage you to think twice. I would really encourage you to think twice. Outside of that, everyone, I'm going to say farewell to you. I'll see you in Pro in Saturday, right? 2 days away. And I'll be back with you next week for another market address. All the best, everyone. Farewell.